there's a lot of upside still ahead, and yet, as you said, there's, I think, a lot of nervousness in the market right now. People looking for corrections and thinking this thing is pretty extended and shouldn't go much higher, if at all. I'm not in that camp. Obviously, I think this thing has legs. It surprised people all year. May, this most recent pullback, I don't know if it changes it, but May, I think, is the strongest May we've had since 2009. So all those people kind of talking like this thing's not done well. It's done well all year, and it's done well recently. So I think its perception is not reality. And I continue to say, melt up ahead. We're in a melt up, and that melt up is just going to get steeper from here.
Hey everyone, welcome to the WTFinance podcast. Sorry, a real quick interruption before the interview. I just wanted to apologise for the change in scenery and potentially the decrease in quality. I'm actually over back home in Australia, so I'm away from my original setup. But yeah, we'll be back there in a couple of weeks, so hopefully quality goes back to normal. But I just wanted to apologise, and hopefully you're still able to get value from these interviews. But yeah, thanks, and let's get to the interview. On this episode of the WTFinance podcast, I have the pleasure of welcoming back David Hunter. He needs no introductions. He's one of our most popular guests and probably someone who's gotten things right most of the time. So, David, thanks so much for coming on the podcast today.
Yeah, hi, Anthony. It's good to see you again. It's been a while.
Yeah, it has. I think we started talking at the start of the year. Yeah, bit of uncertainty, and market sort of ripped a bit since then. And we are seeing maybe a bit more uncertainty at the moment. But what are your current outlooks on what we're seeing in the markets in general?
Yeah, I don't remember when the last time I had raised them yet, but in January, my January investment letter, I raised my targets for the equity market. So I am currently at 7,000 as a target for the S&P. I'm up to 23,000 on the NASDAQ, had been 20,000. My Dow target is now 55,000. And my Russell 2000 target is 3,300. That's probably the one that's the hardest for people to swallow. From here, that's like a 65% move. So, or not from here, but if we correct back down to, say, 2000, which is about where it looks like the Russell's headed here this week. So, 65% move, and I think that move happens this year and probably happens between late summer and the election sometime. That's a obviously very historic move, and even the S&P from might correct back down to 5150, let's say, which isn't very far from here. To my target, it's like a 35% move. So there's a lot of upside still ahead, and yet, as you said, there's, I think, a lot of nervousness in the market right now. People looking for corrections and thinking this thing is pretty extended and shouldn't go much higher, if at all. I'm not in that camp. Obviously, I think this thing has legs. It surprised people all year. May, this most recent pullback, I don't know if it changes it, but May, I think, is the strongest May we've had since 2009. So all those people kind of talking like this thing's not done well. It's done well all year, and it's done well recently. So I think its perception is not reality. And I continue to say, melt up ahead. We're in a melt up, and that melt up is just going to get steeper from here.
Yeah. So what sort of caused you to upgrade your price targets? Is there any catalysts behind it?
Yeah, basically, it still looks like, when I stepped back and looked at the indexes, it looked like there was more room upside from where I had a target 6,000 to 7,000 for the S&P. So it really wasn't a big change, other than my convictions had grown that we were going to see the upper end of that band. For the Russell, which is the farthest from its target, it just looks to me like it is going to break out once it gets going here. I think you're going to see it really gain some speed and take leadership from some of the bigger cap stocks. So it was more seeing that this thing is reaching, meeting its reaching its fruition in terms of, gaining traction, and, fought through a lot of the skepticism, and now seems to me clear sailing ahead. You're going to have 2 and 3 and 4% corrections along the way, or pullbacks along the way. They can happen anytime. So I'm not worried about this most recent couple days. Probably has a little more weakness ahead this week. But by Friday or Monday, this thing could be, back up and on its way to new highs. So, to me, rates are causing a problem very short term. You've had a backup in rates, but this week the Treasury's selling an awful lot of bonds. There's several auctions this week. Today was the 7-year, I think. Tomorrow's the 10-year. So you're seeing supply come in large numbers, and that always causes some congestion. Rates have to go up to allow the dealers to be able to market this stuff and get it out. The two auctions so far this week haven't done great. They indicate that there's some reluctance to buy. So you get a backup in rates of 10 or 20 basis points, and then gives you room to go. I continue to say I think the bond market's in good shape. I don't expect, can always happen because we're at 460 on the 10-year, can always see 5%, but I don't expect that. I think we're nearing the end of this backup in rates. We really, if you go back and look, we've really had a counter trend move in rates back up throughout this whole 5-month period this year. Started at the beginning of the year, has been, choppy upward since. We came down from 5 to 380 on the 10-year last year, or, the fourth quarter. And what we've done here is gone and retraced a good portion of that, but not all of it. We've gone from 380 back to got up to 473, I think, in April, and we're at 462 now. I'm still saying I expect a sub 3% move in rates this summer into the fall. So that'd be a nice move in bonds. And if you get that, and I also expect the weak dollar, you get those things happening, and I think you're going to see the stock market do very well.
Okay, so in your opinion, we shouldn't be worrying about inflation in the near term, at least.
Yeah, I mean, the Fed's worrying about it. We had an uptick in rates and inflation in the first quarter. But when you look underneath the surface, the PCE deflator is 2.7. We're moving towards that 2% target. We came all the way down from much higher. It's just not coming down quickly anymore. The easy part of the move has happened. Now it's more grudging, and you get some, it's kind of a sawtooth thing. You get some backup, and then it comes down. But the economy is not in great shape. I mean, you still have people believing it's, we're not going to see a recession, and that it's stronger than expected. But really, underneath the surface, consumers starting to run into resistance here. Their consumer confidence has been off the last couple of months. Not necessarily the conference board number that came out today, I guess, was an uptick. But basically, consumer confidence, Michigan consumer confidence is showing indications of consumer rolling over, being concerned. You see delinquencies in credit that are picking up speed. I just think we're at a kind of a level where you can't expect the consumer to carry this thing for much longer. We're not imminently ready to roll over in the economy, but we're also not super strong and going to be pushing inflation fires. So I think you're in that period. I talked about this many months ago, that I thought the last stage of the equity market would be partially driven by a kind of a porridge just right type of a mentality, where it's not too hot, not too cold. We're not heading for a recession, but we're not also seeing inflation fires roaring ahead. So I think we're in that kind of sweet spot. It's not it's not a glorious thing, but it keeps the market moving. And I think there's still a lot of skepticism among investors. Retail investors have pulled back. A recent Schwab survey showed that they're concerned, and the institutions continue to kind of fight this thing. As always, the momentum has been pretty good here this year, so in the market. So, they have raised their targets to mid fives, 5,500. You're not far away from that. But I think they all feel like there's a lot of problems that could surface at any time. So the skepticism there, wall of worry is there, and that's what fuels an upside.
Yeah, thanks for running us through that. So, are you seeing this disconnect? It seems like there's sort of and people have been talking about this for years. There's quite a big disconnect between the economy and the markets. Do you think that's something that's going to continue, or do you think once, as you said, the economy rolls over, potentially in 6, 12 months, or whenever it happens, that we are going to see a market correction from there?
Yeah, I don't see a big disconnect. Frankly, this last 18-month move from 20 month move from October of 2022. Initially, it started as happens when you come out of a bear market or come out of a sort of a semi-recession. Earnings were down, and we went through that period where earnings were they kind of had to lower expectations, and then earnings kind of did okay versus expectations. But of late, you're seeing signs that earnings are picking up speed. So I don't think there's really a disconnect. The U.S. Business community U.S. corporations have done a good job of basically keeping earnings going while they face some headwinds in the economy. And now there's a feeling that the earnings are actually on an upswing. So I think the market's acting rather rationally. What was irrational was people got caught up in the scenario. Me, I have a global bust forecast out there, but it's not yet. And I think people started worrying about those kind of concerns way prematurely. And so 2022 happened with the Fed tightening, and they just never got out of that kind of gloom and doom viewpoint. And of course, the tapes dragged them up kicking and screaming. They are driven by momentum, and the momentum was going against them. They finally had to kind of grudgingly get on board, but they're not ebullient by any means.
So do you think there's still investors out there? Because from my perspective, it seems like things are quite bullish. You're not seeing much bearish sentiment. Are you seeing the same? Are you seeing the opposite?
No, that's what I just said. I think the institutional investor is not bullish. He's not a roaring bear, but he's a raving bear. But he's looking for bigger pullbacks than I think he's going to get. And the retail investor, like I said, the Schwab survey this week, they are very nervous here. So I don't think sentiment surveys may tell you something different, but when I look at investors and where they are, they're not confident. They are there because the market is there. They're forced because of the tape to kind of say, well, I don't want to fight this too much or I'm missing out. But they're there in a nervous way, and you see that whenever we get a correction. We had one in April. As soon as you get a 2 or 3% pullback, or even a 1% pullback, you have people coming out of the woodwork talking about a much bigger correction. They I told you it's coming. Here it comes. And so I don't think there's any conviction to the upside. What I've seen is when we went to new highs, yes, people got more bullish. The institutions got more bullish, but with very little conviction, which means then the only thing keeping them up there is the momentum of the tape. And then when you get the pullbacks, the momentum reverses, they're quickly back to seeing the downside. That's not bullishness.
And then when you look at the Russell 2000, because I think, as you said, that's probably one of the calls which there'll be most, I guess, skepticism about, because it's, really lagged, I guess, the other indices. And it's if you look at the companies, I don't know the exact fact, but quite a lot of them aren't actually profitable. And I think a lot of the returns are from sort of this top few companies, which isn't uncommon for indices. But why do you sort of have this thought that it's potentially going up 60%?
Yeah, there's a couple things. Obviously Russell is populated by a lot of small banks and small financial companies. So the banks got hit hard in 23, in the spring of 23, and have kind of been fighting ever since. So that hurt the Russell. We've been in an economy that has been struggling, and we had basically a rough economy in 2022 when the Fed was tightening, and 23 was kind of, slow growth. So the smaller companies have a harder time overcoming, slow economy. So that has all held the Russell back to some extent, and they're very interest rate sensitive because of that, because they are, dominated by financial companies, et cetera. And rates have been up. So all that means that Russell's being rational, I guess. But if you look at it, it's come up from its lows quite a bit, from the October lows certainly, and there's a trend line there. Every time it corrects back to what is an uptrend line. I don't see anything disturbing about what it is, except that it's lagging the larger cap indexes. So, of course, the Nasdaq led the way because of Nvidia and the so-called Magnificent Seven early this year. Some of those have slowed down, some have kept going. But this narrative that's out there that everything is the Mag 7 or everything is a few tech stocks or everything is Nvidia is just false. You've had strength in industrial companies, a lot of strength. You've had strength in the home builders, starting to take a little gas there now, but you had strength in those. You've had strength in, copper's caught some fire. Obviously now the metals and miners are starting to pick up. So it's a myth, and even I like to look at the XBD, the broker dealer index, as a very bullish index. If you look at it, I think there's a lot of upside coming in there, including the Goldman Sachs of the world, but also the smaller investor like the Schwab customer is going to be fueling a pretty good move in those retail brokers too. So I don't, those that want to be bearish, good luck, because I when I step back and look, there's a lot of reasons to be bullish, and it's not. Yes, we've had a narrow market at times. Early this year was very narrow. It's broadened out since, but then what people do is they don't understand. So the Russell started to go, and then with this backup in rates, the Russell backed up. They forget the part where the Russell did start broadening. Russell and other stocks did start performing better, and you did have a broadening in the market. They go back to the worst case when, after a pullback in those indexes or in in a lot of those stocks, and say, see, the breath isn't any better. Well, it is better. It's a stair step process. So there's a lot more to this market than just Nvidia or just the Mag 7s, and it's going to get broader as it moves towards the top, which is what I've said for a while. When I look below the surface, there's a lot of things to be bullish about, not bearish.
Okay, that's really interesting. And but before you were talking about how I guess a lot of the institutions are, they're reluctantly bullish. Do you think that's why we're seeing precious metals increasing as well? Are they the ones sort of going in to try and hedge themselves against the equity risk, or do you see that as being other drivers?
Yeah, because they've been so slow to break out. I mean, they were, as you know, they were a disappointing group for years. Gold itself was, basically made an effort to break out to all-time highs 3 or 4 different times over the course of a couple of years. So gold was up near its highs. silver was lagging a lot, and the miners were lagging a lot. The fact that they're moving now, I don't think has a lot to do with the broader equity market. I think it's really um, part of it is maybe the tensions around the world. Part of it, I think, is that gold did break out finally, and silver's starting to follow. So I think it's giving more encouragement to something that didn't look like it was going to happen. And again, just like so much of the market, it's momentum. Once they get above certain resistance levels, they attract more interest, and that begets more interest. So I think we're early on in a very big move coming. I've said before, I think gold can get 3,000 this year pre-bust. I think silver can get to 60. These are long held targets, and I've said of late, if it breaks above 60, I think it could get to 75 very quickly. So silver, my target range is 60 to 75, and gold it's 3,000. And I've said I would not be surprised if that 3,000 proves conservative. And the miners, I mean, I think they've got certainly doubles from here, and some of them even triples from here, pre-bust, which is basically this year. So there's a lot there that wasn't there, just 6 months ago. They've really caught fire.
Hey everyone, sorry for interrupting. I just wanted to extend a massive thank you to you for listening and tuning in, and for your support over these 3 years. So we've had, hundreds of guests that we've welcomed on the podcast. We've had millions of views with hundreds of thousands of different people listening in. So I just wanted to thank you. I started this as a student, and now currently working, and I've always done this on the side just because I have a passion for it and I've enjoyed it. And probably similar to yourself, you listen to all these, different YouTube channels and podcasts of people listening to different guests. That's how I started, and I just wanted to sort of take the plunge and be able to have the opportunity to speak to these people, and you've made that happen. So thank you very much. Just myself, don't make any money from this, and it's really a passion project. So thanks for supporting that passion of mine. If you wanted to support the channel, all I ask is if you could like, subscribe, or even comment, positive or negative feedback. I'm always willing to take constructive criticism. I'd really appreciate that. But otherwise, thanks so much. If you can believe it, only 14% of our listeners actually subscribe to the podcast. So yeah, if you can, great. If not, no problem at all. Thanks for listening. Yeah, it does seem to be a sort of an everything bubble, and assuming that bonds, the yields go down as well as you're saying, then we'll have bonds sort of increasing as well. So it's going to be almost every asset increasing at the same time. Are they correlated? I guess the bonds and equity, but then you said precious metals is uncorrelated, or yeah. How do you see that?
I think they have their own. Yeah, I mean, with the market, obviously, as they gain momentum, they'll be part of the market. And I think institutions own so little of the precious metals, and that group is such a small capitalization that if institutions ever decide they need to have 5% of that in their portfolio, you can run these things up just on a supply demand basis for the stocks. So, and that's what I think is going to happen. It doesn't take much when you're in such a small, thin group. When nobody wants them, yeah, they can kind of wallow around in the bottom. But once they break above some levels, and institutions take notice, it's look out. And in terms of everyday bubble, I hear that a lot. I think it's premature. I mean, maybe stepping back and looking at the big picture, yeah, it's maybe a bubble. Yeah, I think there is a bust to follow. But if we're 40 or 50% away from a top in the stock market, it's a little hard to be talking about a bubble here, right? I mean, it is we are moving into what I think will be a parabolic move, so you can gain a lot of ground in a short time. So time wise, I think we're not that far away from the top, but distance wise, the returns we could get this year between now and say election time, and probably before that, are the kind of returns that you normally have to wait 2 and 3 years to get. You have to work through several years of returns to get this, and we could get it all in 6 months or less.
Yeah, that's uh, amazing to think. Um, so you've mentioned some industries. You said the industrial sort of, yeah, home builders are sort of coming off a bit, but they've done very well. Small financials. Are there any other industries that you're currently watching that you think could outperform during this period, or do you think it's just going to say be, floating tides, all boats go up?
I think mostly it'll be all boats go up, but I think the financials are going to gain momentum here. As I said, the broker dealer group looks good. Banks, I think, will do well, and probably the larger ones better than the regionals, but the regionals will have a catch up rally here. I think the industrials still look very good and can continue to lead. Semiconductors, which has been my highlighted group all the way through since I turned bullish or started talking about this move 20 months ago. Um, as far as they've moved, they look they still look good. I have a target of 300 on the SMH, and I know that's going to have to be raised. Whether it's 350 or 400, I don't know, but I think that's the kind of upside you still have. And the consumer isn't the place I would probably focus, but I think even consumer discretionary is going to have, some room to run. I think steels can run. I think copper has a big run ahead of it. There's just so many places. A lot of the commodity area probably will have a run here. So, what could surprise, we got everybody. We had everybody in the early this year assuming the Fed was going to be cutting well before now, or certainly by now. And now we got everybody assuming, maybe we're going to get one cut this year, maybe no cuts this year. Um, I think the surprise could be that things start slowing here in the summer, between June and August, and the Fed comes back, and the expectation to come back around to cuts, where the Fed says, yeah, we we can't just ignore the fact that the jobs picture is starting to deteriorate, bank loan picture is starting to deteriorate, et cetera. And inflation looks okay. So I think the traders move the expectations around, and the Fed kind of goes with the traders oftentimes. Um, but what we forget is what looks like an entrenched viewpoint by the Fed or an entrenched viewpoint by the market can flip on a dime if you get a few numbers going the other way. And so I can't say for sure that that's going to happen, but I think that's a wild card out there for sure. Is that we might be right back in cutting mode here soon, or expectations of cuts.
Okay, and yeah, it's crazy to think, but it probably add further fuel to the current fire. Um, if we look at, crypto is one of those assets that sort of correlates quite well with the Nasdaq, and do you see that sort of being another asset class that's going to perform quite well during this period?
Well, I always beg off and say I don't follow crypto. I don't follow Bitcoin. It's had a nice run. I mean, it's not that I'm unaware of what it's done, but for me, it's just not. It's not a big enough area for me. It doesn't have the kind of macro implications yet. Maybe somewhere down the road it will. That I need to follow it, so I don't really have an opinion. As I have said many times, let's see how it holds up in the bust. It hasn't been really battle tested. It's still a relatively new vehicle. Let's just see in a very um, dire period of time when risks are rising and most assets are getting hit hard. Let's just see how it holds up, because I suspect it's gonna not be it's certainly not going to be a place where you are protected, I don't think.
Okay, interesting. So if we look globally, I think a lot of the concern and volatility has been around geopolitical risks. We've seen sort of China doing lots of things around Taiwan, throughout the Middle East and other places as well. Is that something that you're following and you think could have an impact as well?
Certainly, if Taiwan were invaded, if China decides this is the time, um, you know it's going to hit the markets. I'm not blind to that. But I think the likelihood that China chooses 2024 as a time to do that doesn't make a lot of sense when they've got a lot of problems on their hands already. I mean, do they need to alienate their biggest end market? And certainly the two biggest end markets, Europe and the U.S., U.S. being largest. I don't think so. If we see it always from our side and from a concern viewpoint, we always expect the worst out of them and things, but they're pretty rational, I think, for self-serving rational. And I think they got their hands full. Their real estate market is a mess. Their pension system is a mess. Their economy, they don't have an easy solution to jumpstart their economy again. They're faltering, and they got a huge population to satisfy. So maybe they use that to distract, but I would think that that's a risky. They're typically more a risk averse population or a risk averse government. I would think they'd say this isn't our strongest time to be doing this. So, yeah, I'm pessimistic about what our country is doing right now politically or how it's being led, but I don't think China's looking for a battle right now. And so my guess is it's a low probability event for this year. And as a result, I don't really factor it into my work. I just know that if it happens, I'm going to have to reverse myself to some extent. But I don't think that's likely.
Okay. And are you factoring the issues of the US election or just the US election in general?
Yeah, surprisingly, elections usually have a big impact on markets in the election year. My forecast is not really using election as much of a factor. I as big a difference as Trump and Biden are policy wise. I don't think it makes a difference for the short run. Meaning, I think we get a melt up no matter who ends up winning the election. We get a melt up prior to that. I think we get a global bust after the election, no matter who wins. So I don't think that is a big deal. I know people think the Fed is probably trying to support Biden, or that means you're going to get some pump priming, etc. Frankly, I take Powell at his word. They're trying to be as apolitical as they can be. They're focused on, they're in a tough place. They don't want to take this thing over the cliff, but they want to defeat inflation to the best ability they can. And so I think they're focused on their mandates and not the election. Does that mean they're totally unawares or that they don't hear from Yellen or other things? No, of course. I mean, reality is that there's some of that, but I don't think you're seeing policies being driven by the election.
Okay, makes sense. So, David, thanks so much for your time today. Really appreciate it. My last question is, what is one message you'd like people to take away from our conversation?
Yeah, I guess the biggest message is that there's a big runway. Time wise, there may not be a lot of time left to this, what I call a 42-year secular bull market. It started in August of 1982, so we're approaching the 42nd year anniversary. So time wise, there may not be a lot of time left, less than 6 months, possibly. But from a distance, like I said, anywhere from 35 to 65% upside, depending on the index. That's a long ways away, distance return wise. So people should not, I like to say on Twitter, ignore the noise. There's a lot of chatter out there trying to convince people that the risks are high and scaring the bejesus out of people. My convictions are high that there's still a good bull run ahead of us, pretty long one. So in terms of returns, so that would be my takeaway, I think.
Yeah, and you have been a contrarian for sort of or I guess now it's what everyone's expecting. But you were saying this sort of close to over a year ago when people were thinking everything was going to collapse. So it has been you've been right so far. So I'm sure it's we'll continue to see that, even though they're quite audacious goals. But yeah, thanks so much for coming on. If anyone wanted to find out more about your work and what you do, where would the best places for that be?
Sure, I'm on Twitter every day, or X, whatever you want to call it. I still call it Twitter. And you can find me there at Dave H. Contrarian, not David, but Dave at Dave H. Contrarian. And I also publish a quarterly newsletter, macro letter that is by subscription. If anybody is interested, it does come with a cost. All they have to do is direct message me on Twitter, which is that little envelope. When you go to my profile, you'll see a little envelope and click on that to send a direct message for those that aren't familiar with that. And I'll provide you details in terms of what the letter contains and the cost involved.
Perfect. Sounds great. I'll put that in the description below. But thanks again for your time.
Okay, Anthony, good to see you. Take care. Enjoy your summer.
Thanks. Same to you. Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment. Good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right, thanks again.